In this video, I'm going to walk you through how to read a balance sheet, and we're going to take a look at the balance sheet of Drone Delivery Canada. Now, first of all, what is a balance sheet? Well, a balance sheet is a snapshot in time of a company. It kind of tells the story, the financial story of where a company is at and how they got to where they're at today. A balance sheet will show you the assets and the liabilities that a company has. The assets are things that they own, such as cash or equipment or a plant or inventory or a brand maybe, or intellectual property or patents. And a liability is something that they owe somebody. Maybe it's debt, or maybe it's money that they've collected that they haven't rendered services for, or maybe it's a loan, or maybe they owe one of their suppliers. It could be a variety of different things, but the balance sheet documents what they own and what they owe and what they basically have done with their shares. And so in this video, I'm going to walk you through how to actually read that statement. Okay, so here's what a balance sheet looks like. The first thing you want to do is make sure you're looking at the right company, and then you need to understand the date at which this balance sheet is for. The balance sheet, like I said, is a snapshot in time, and in this example, it is going to compare the balances on December 31st of 2023 with the balances of December 31st, 2022. Now, in a balance sheet, you're going to have three main categories. The first one is assets, the second one is liabilities, and the third one here is equity. It's called a balance sheet because the assets will always equal the liabilities plus the equity. So here in this example, you can see they have $10.3 million in assets. And at the bottom here, you can see that their total liabilities and equity is $10.3 million. It's the exact same number. And so in this situation, the balance sheet balances, which means we're probably looking at good information. Now, anytime you look at the balance sheet of a publicly traded company, those numbers are always going to add up. It's not really something that you have to watch for or be careful of. I'm just pointing this out to you so that you can understand how the balance sheet works. So now let's break this down section by section. When it comes to the assets here, it is separated into current assets and long-term assets. Your current assets are going to be anything that's super liquid or money that's going to be coming in the next 12 months. In this situation, we've got prepaid expenses, trade and other receivables, and cash equivalents. This could be actual cash sitting in the bank, or it could be cash that is invested into short-term bonds. Now, when it comes to long-term assets, these are usually more permanent assets and things that are less liquid and maybe not likely to turn into cash in the next 12 months. Here we've got patents, trademarks, equipment, leasehold improvements, and right-of-use assets. The big red flags that you're looking for in here are if they have any big numbers associated with goodwill. It basically means that they bought an asset and paid above what the actual market value that they can put on their books is. So not usually a great thing. Moving on to the liabilities here, again, it is broken into current liabilities and long-term liabilities. Here you have things like trade and other payables. So if you owe money to a vendor, that is going to be in here. You've also got lease obligations for rent, at least the current portion of it due in the next 12 months. And then deferred revenue is actually a good thing. This is customer deposits from money that they have given you, but services that you have not rendered yet. So if somebody pays for like a 12-month subscription and they're only on month three, then they probably have like 9 months worth of deferred revenue. And our last category here is labeled as equity. It's also known as shareholders' equity. And here you have everything that has happened with the shares. So for instance, share capital is how much money they have raised by issuing shares. Share-based payments reserve is how much money they have saved by issuing shares instead of salary. And then deficit is how much money they have actually lost so far since starting. And so what's great about a balance sheet is it tells you exactly what the position of the company is in terms of their cash balance and what they have in the bank. It also tells you what type of debts they took out to get to where they're at. In this example, they issued shares for $96 million to put money in the bank and develop the company. And so you can kind of build a story as to where the company's at and how they got to where they are. Now, just to give you an idea of a transaction that would hit the balance sheet here is, let's say that a company goes out and gets a bank loan for $100,000. That would increase their cash balance and their assets by $100,000. But because the assets have to equal the liabilities plus the shareholders' equity, we have to make a transaction down here as well. And so if the cash balance goes up by $100,000, the current liabilities or the debt for that $100,000 is going to go in here. And so as the assets increase, so do the liabilities, because you have $100,000 more in cash. You now have $100,000 more in debt as well. I hope this helps. If you want me to make a video breaking down the income statement as well, just leave a comment and hit that follow button. I sincerely appreciate it, and we'll see you in the next one.